There's a perfect storm happening in investment. It's driven by three trends. And if you feel like winter is coming, you've come to the right place for help. Hi, I'm Raymond Hegarty, IP advisor to high growth companies. I'm also the author of 3 best-selling books on IP strategy for business. The first trend is the drastic change in investor sentiment. Back in 2020, investors seemed to be in a frenzy of deploying capital. Their fear of missing out meant that often they would invest in a company even before they got to meet with the founders. All of that's changed, and it's more difficult for companies to get investment these days. In the intervening period, there was a real pause. But investors know that they need to deploy capital if they want to generate returns. So now they're back in the market. But they have much more choice and they're much more careful. This has led to far stricter due diligence. This is both a challenge and an opportunity. Investors want to know, and you want to show. The second trend is a longer-term economic shift. Back in 1975, when the world's biggest companies were in industries such as oil, banking, and automotive, the value of the S&P 500 was 83% tangible and 17% intangible. With the emergence of companies like Microsoft, the intangible component grew to 32% by 1985. By 1995, people had started to copy Apple's approach to innovation, and the percentage of intangible value rose further. This trend has continued. And now intangible value represents more than 90% of market value. This is a massive inversion from 83% tangible in 1975 to 90% intangible these days. What that means is that in 1975, we had very little overlap between intangible management and business management. That overlap was all about protecting intellectual property. These days, with a 90% overlap, it's more about building intangible value. The other element to consider is risk. In 1975, the invisible risks were 17%. These days, 90% of your risks are invisible. Building the intangible value and mitigating the IP risk are the two key elements of your intangible strategy. The third trend is the emergence of due diligence. Forbes magazine found that even on a highly produced and edited show like Shark Tank, half of the deals that were agreed on air did not close after the cameras stopped rolling. A further 15% of them went ahead only after the terms were changed. If you're going through a funding round or preparing for an exit, it's very exciting to get an offer, but don't pop the champagne yet. There are usually some hooks with that offer. Very often, there's an exclusivity clause. They may insist on due diligence. The circumstances could change. Geopolitics, a cancelled order, an alternative technology. The investor could walk away and you get a failed deal. Also, while the process is happening, you're distracted from running the business, so the business may actually suffer as well. The term due diligence itself comes from a quaint old legal definition, meaning the reasonable steps taken by a person or organization to avoid committing a tort or offense. In other words, avoiding something you could be sued for. In business, it's a careful investigation of the state of a business by a person or organization that is thinking of buying it or investing in it. Due diligence is looking at valuations. This valuation is the combination of value and risk. The terms of the offer depend on the value that you pitched. When they examine it, they discover the value is lower than they expected, and then they find that there are some more risks as well. This leads to a revised valuation which is lower than the original offer. The economic formula for risk is the impact of the hazard multiplied by its probability. For example, if you have a $1 million exposure with a 50% probability, the economic risk is $500,000. An investor could look at the same exposure and see it as a $1 million risk. They might even say they need to discount the deal by $1.2 million to make sure that risk goes away. Or if the risk gives a sense of too many red flags, you could end up with a dead deal. After cases such as Theranos and the crash of the FTX cryptocurrency exchange, lots of people asked, where was the due diligence? This year, there definitely is due diligence. Due diligence used to be just financial and legal topics. But in recent years, that's expanded into multiple types. Of course, there still is financial due diligence. Theranos was a reminder that you need to check that the technology actually works. These days, checks often also involve a cybersecurity element. You've market due diligence to check out those rosy projections. You want to make sure that the management team is capable and that they're committed to the ongoing success of the company. Then you've got legal due diligence. Recently, that includes questions around GDPR, data privacy and security, and the IP element, which could come back to bite you. You remember about how IP strategy is about value and risk, and how due diligence is about value and risk. Because 90% of the value is intangible and 90% of the risk is invisible, you can see why IP due diligence is now 90% of what's important. Investment used to take 3 to 6 months for a deal to close. These days, it's taking from 6 months to more than 9 months. All founders are optimists. Many secretly believe they will still close in 3 months. But do you have enough runway for longer? You certainly don't want to get stuck in a long due diligence. How do you wow your investors and avoid getting stuck in due diligence? You need to get good at telling your IP story. We'll cover this in another video. Imagine what it will feel like when you pass due diligence. When you close your investment, you can get on to the next phase of running your business. Closing the transaction faster massively de-risks your business. And due diligence is not all about just passing the test. It's an opportunity to impress investors about your well-run business and give them confidence about their future relationship with you. And you can get much more information about IP strategy right here.